The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers from Akers Financial Group, and we welcome you to Winning in Retirement. Today, I have certified financial planner practitioner Alex Monk. Good morning, Alex.
Brian, it's good to be with you.
Are you doing okay? You've been with Akers Financial Group over 10 years. Are you still able to keep working as hard as you have been working?
Some would say I'm thriving, Brian.
Oh, that's what our show's going to be, is about thriving. Surviving and thriving in retirement is our topic for today. So the reason we're doing this is because Alex and I have hit the road this last week and have done some public speaking to groups around 35 each night. And our topic has been surviving and thriving in retirement, talking about what's going on right now and how people are a little edgy and a little worried about what should they do? Should they really retire now? If they pulled the trigger last year, what to do now? So what we're going to do is sort of take some pieces of that seminar, that talk we had, and we're going to bring that to you live on the radio show.
I can't wait, man. It's going to be fun.
All right, so the day in the first quarter is this. We're going to cover surviving and thriving in retirement. Surviving is where we got to know what's going on, make sure things are positive. Positive cash flow, very, very important. So let's just begin with some basic things. We're getting a lot of information today, but at any point in time, just call our office and set up a time to meet with one of our team of advisors. And that'll really, truly help you understand where to get started and how to make sure that you will be thriving and surviving during your retirement years. So we're trying to give sound financial advice, but it's general in nature, right?
I mean, everything that we're going to talk about is just different topics. Everything's going to apply to different people in different places because everybody's different.
Absolutely. Extremely different. They're almost like a fingerprint.
Wow.
Yeah.
Interesting concept. Go into that a little bit.
All right. So a fingerprint is individual to you. And just like a financial fingerprint is individual to you, that is where we start in our financial planning process. And so that's how we get to know people, get to know where they are so that we can decide within the constraints of their goals what to do next. So retirement, think about the actual doing and being retired. It's a new voyage in life. It's a time in life where things change. Mentally, you're like, all right, so I need to rely on everything I've saved, everything I've built up through pensions and years of work, and I have to live on that, not on my sweat, on my hourly work, like going to work tomorrow, I can make a paycheck. You got to count on what you've saved and built up.
And, for me, like that's the biggest thing in my brain is like I know that no matter what happens, I can get up tomorrow and I'm going to go to work and I'm going to grind and I'm going to be able to make money. And for me, coaching people into that transition phase, that like 1 to 2 years right when you retire, that's a lot. Like that paradigm shift is huge.
Well, some people, they can't wait, and it's like their whole life they're made for retirement. They can't wait for that day. They don't skip a beat. Some clients, they can't leave work. They're like, I'll go from 5 to 4.5 days, and they slowly narrow down a slow into retirement. So it's also individual to yourself about this retirement. Now, what happens in your retirement is this, is that a lot of times some habits have to change because you're no longer going to work, so you got to be self-motivating. You got to see what you need to do. There might be a honey-do list. There could be...
Structure's not a bad thing, though.
A structure is good. Gets you out of bed, gets you moving.
McDonald's at 7 a.m., a little coffee with the old folks. Everyone's got a different thing that they do in retirement.
Yeah, I think they meet at 6 a.m. at McDonald's.
Yikes.
Yeah, depending on what group you're in. But McDonald's has been a great hangout for many people. They had a little pause for a couple of years, but now it's getting back there. The other thing is that when you're investing and spending money, one of the things you got to think about retirement is how should that change? What is your budget? Do you actually know? We do believe part of building a financial plan to last a lifetime, to truly help you survive, is to know what money you're spending, what money you need to spend, so you can and figure out what's extra so you can do those other things.
I mean, how many times have you had someone come in and they're like, hey, Brian, can I retire? And then you say, what do you need?
And they go, oh, we don't have a budget. And then we get into it, like what's going on, what's your financial fingerprint, and we talk about it, and we work on it, build it up, and get them ready ultimately to retire and to pull it that day.
We help them make that budget. It's not something that you have to come in with. I mean, it helps if you know your numbers, but that's what we do. When we wake up and we plan.
Yeah, the idea is where an advisor's job is to help. That means if you don't want to do it, you hire. It's almost like If you don't want to do your landscaping, you hire somebody, right?
I mean, I don't cut my grass.
Oh, you don't?
No.
I love cutting grass.
Oh, man, they do it in 30 minutes.
I know. I take my time. As long as it's sunny on a Saturday, I can do it. Or one night. All right. So some other things that happen when you retire is there's a change of focus on investing from accumulating to actually using your money to withdraw your money. That can be painful by itself, right?
Going from saving, accumulating, watching your accounts go up, putting money away, to the complete opposite is it's a shock for a lot of people. I mean, it's like jumping in a cold pool.
Yeah. It makes you scream a little bit. And actually, the idea is, you're saving and investing and you're thinking about, I want to make this money really build up and grow. And then it gets there and then it's like, oh, I don't want it going down. And then we try to explain some basic topics of we like to earn 6 to 8, 7 to 9, but we do not want to withdraw 6% or anything above 4 because we don't want to be taking money that's greater than what we're earning.
Yeah, and we'll get into that, some sequence of returns a little bit later, but we want to be in a reasonable spot, especially early on. And, with everything that's been going on, Brian, I know you've seen it a lot and I've seen it a lot. People are retiring earlier. So those withdrawals in the early parts of retirement are a huge deal.
Oh, yeah, I believe that we need to live off the interest dividends that it provides. We should not be eating into our retirement until we get into our 70s.
Right. So if your retirement nest egg is a cow, right, you don't want to have hamburger the first night. You can't have steaks the first year. I mean, maybe yogurt.
Yogurt.
Well, a dairy product.
I don't know how you make yogurt, so you got me on that one. Retirement yogurt. That's the new thing from Alex Monk. Well, actually, we're going to talk about some exciting things, such as longevity. Have you thought about retiring at 60 and then realizing you could be retired 30 plus years? Will your money last a lifetime? That's very important to do. So longevity has to be a thought with your money. The other thing you got to think about is this thing called inflation. Yeah. It's been happening recently, and the way you notice that is when you bring out your wallet and everybody who you're buying stuff from are asking for more money for the same thing.
Well, I mean, everyone that's listening to this in their cars feels that.
Yeah.
$5 a gallon.
Yeah.
That's a big number, man.
The water costs more.
It does, doesn't it?
It does. If you think about it, it's like, gas is pretty cheap compared to bottled water.
Yeah, I mean, it depends on if you're getting that artisan stuff, you could be paying a fortune.
Yeah. We're also going to talk a little bit about taxes. We love talking about taxes and how to avoid tax and how to have tax-free. That's a major topic throughout Winning and Retirement radio shows. And of course, you can always go to our website at akersfinancialgroup.com to hear any past show and find out what we think on a lot of different topics. Today's topic is surviving and thriving in retirement. Surviving and thriving is all about understanding retirement and getting yourself ready for that period of life. Now, one of the other concerns during retirement is the risk of the stock market. And that means that we have to identify where our money is and what amount of risk that we need to take.
You know, one of the things from our public speaking this week that it really hit home, I said, what if you just retired and you just got your quarterly statement or whatever and you saw this huge loss and this guy in the front row just starts laughing uncomfortably. Yeah. I'm like, did that one hit home a little bit? He's like, yes, it did. And that's a real thing. If all your money's in the market, man, it's going down. What are you going to do?
And that's why as you pre-plan for retirement, you get ready by lowering the risk as you're getting closer and closer. That lowering of the risk means you put some money to where it has protections, where we avoid the possibility of loss. It's an extremely important thing that you need to do. Now, so we talked about longevity a little bit. Many times when we're thinking about our retirement years, there's sort of those retirement years where you're running around doing lots of stuff, reasonably healthy. And then as you get a little older, you start seeing more and more doctors. They're on your schedule. And then you start to slow down a little bit. And then there's sort of towards the end might be different types of medical and how do you take care of yourself and your spouse. All kinds of phases.
And there's typically a correlation with your height, right? So when you retire, you may be 6 foot.
Yeah.
But towards the end, you might be 5'8".
Oh, my. Well, that's because our backs have problems, our neck, and you do shrink a little bit.
Yeah. So, I mean, there's different phases of life, but at all those different phases of life, one of the most important things you said earlier, Brian, was there's different goals for those different phases. Mm-hmm. But they all are geared towards, being successful. No one wants to sign up for something they're not going to be successful at.
Right. And like when you're in your 20s and 30s, you're thinking about tomorrow and what you need and how to get there. And you don't think about the future as much. And we want you to at least have some thoughts about that long-term future so that you can do the things you need to do to get money thrown to your financial future, because there's very few people saving money for you in that future.
Yeah, well, I mean, in most cases, there's no one.
Yeah.
So you got to do it yourself, and it's not like you got a pension anymore. A lot of places are getting rid of them.
Getting rid of them, they're shrinking down what they're going to offer, and then you have to have multiple components to be able to retire, and you must save right away. Hey, I think the number's 10% minimum.
Oh, yeah, at least.
Yeah, minimum to start 10%. If you can do 10% saving and then live off the rest, get that money saved and put away.
Well, and the sooner you start it and make it part of your budget, the easier it gets.
Now, people, they love to think about, I'm going to work 30 years. So if you start at 22, that's only 52. If you live to 92, that means you're going to retire 40 years. Now, some people have careers where they can do that, where they set aside money and they lived well within their means. They enter retirement with no debt, and it becomes a very doable scenario.
Yeah, I mean, but you have to be disciplined. I mean, it's no debt. It's within your means. It's such a big deal.
And not everyone can do that, because in America, they're constantly bombarding us with things that you need to have, things that are easy to get to. They have these trucks that will bring you anything you want to your house. Have you ever done that before, Alex? Do you have an Amazon habit, Alex?
I have an Amazon and a DoorDash habit like none other. And I justify it with, using that time to work a little bit harder.
Okay. Yeah. So what happens is that we all want to be retired and we want to do all these things. You have all these dreams. My answer is this: let's balance life now. Enjoy some of those goals and dreams now, and also in retirement years. Try to save for those retirement years so that you won't have to work in them. Make sure you're saving some money now and throwing it to your financial future. So what reason we talk about this is that in retirement, the biggest worry of your day should be where you're going to drink your morning cup of coffee, where every day seems like a Saturday free of stress. Retirement income investments are taken care of by the team of advisors at Akers Financial Group. If this is the future you want, it's not too late. It's so easy to begin winning in retirement. Meet with one of our team of advisors, a free meeting with you and about your family's retirement. You can call us now at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will call you back on Monday to schedule a free in-person or Zoom meeting. Go to AkersFinancialGroup.com or give us a call at 833-946-7384 to start planning for your retirement now. What does the price of a gallon of gas in 1975 have to do with your retirement? We'll discuss this in 2 minutes in the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Yes, welcome back to Winning in Retirement. I'm Brian Akers, founder and president of Akers Financial Group. Here with me today is Alex Monk. He's the chairman of our investment committee at Akers Financial Group. He's a financial advisor. He's been with us for more than 10 years. And Alex, are you ready to go here in the second quarter?
I'm just getting warmed up, Brian, but yes.
All right. I know you are. It was pretty fun that first quarter. For those that listened, I hope you're ready to go. We got a lot of information. We ended that last quarter in saying the following is: what does the price of a gallon of gas in 1975 have to do with your retirement?
I know people out there driving right now wish that was the price of gas today.
And do you remember what it was?
Was it 57 cents, 56?
That's what our charts say, because I don't believe you were born in 1975.
I don't believe I was either.
Not saying your age or anything.
I do not have hair, but I am not that old.
All right, so 1975, with a chart we looked at, it was 57 cents a gallon for, back then, I guess it was leaded gas. And that gas, you had to wait in line for it, but it worked out pretty well. Nowadays, the gas price goes up every day, so whatever price we say right now will probably be lower than what you just paid.
Yeah, I mean, $5 is basically what I paid last time.
Oh, yeah?
I mean, that's a lot of money.
Yeah.
I don't ever let it go to empty right now because it's just too depressing to fill it all the way up. It just costs way too much money.
All right. So what happens is that we see the price of gas going up. That is the very definition of inflation, where things cost more to do the same thing. If you go to the grocery store, things cost more. If you go to a hotel, go to Disney World, you go on vacation, you go to buy a car, you go to rent a car, everything you're looking at doing costs more. Now, what happens is when your expenses are going up, you got to look on the income side. How can you raise your income? So you have to have a retirement plan built in a way that's reliable. It's going to be stable, but has the ability to increase throughout your retirement years.
So that sounds like COLA.
COLA?
Like COLA. Like
Coca-
cost of living annual increase? Or?
No, not Coca-Cola.
No. It's COLA.
COLA, cost of living annual increase. Okay?
Yeah.
What's that?
So that the old school pensions, right? So that's where every year that there's, whatever they attach their inflation number to, which is a whole different bag of worms. But it's an increase of your income each year to adjust to inflation or the new cost of living.
Yeah, so if you happen to notice, if you're probably a government worker and you've had a pension, if you put in your 20 to 30 years, depending on which type of work that you do, you've noticed that they've taken away the unlimited cost of living, and they limited you to 3% or 3% simple. Can you try to explain that to me?
Okay, so 3% on like a non-simple, like a compounding would be, let's say you had 10,000 and then they give you 3% on top of that. And then next year, they're going to give you 3% on top of 10,000 plus your other 3%.
10,300.
There you go. He's good at math, guys. Now, a simple would be where no matter what your current pension is, you're only going to get that $300 on that original 10,000.
Every year you have a max.
That's your max.
That's the max. Now, if the inflation or cost of living's less, you get less.
Right.
So it doesn't accumulate or grow. So what happens is, let's just use federal pensions as an example. The old civil service had unlimited cost of living adjustments, and that's where in the last 12 months you've seen a really big increase. They hadn't seen that big of an increase the last 20 years, but now we saw a big increase. If inflation starts to progress very quickly, we're going to go from an average of 2 to an average of 4 over a long period of time. The idea, though, in the next decade, we might see 4, 5, 7% averaging for a decade. If we got all the way up to 7% for a decade, that means what you spend will entirely double over the next 10 years.
Say that again. The rule of 7?
It's the rule 72 is that if you have a 7.2% increase, such as inflation like we've had last year and we have this year, if that kept going for this decade, I don't think it will, but if it did, we would then have a doubling of our cost of living. That complete double, can your current retirement plan handle that?
Well, and a lot of people, if you're out there thinking, well, I took out all my growth, the answer is no.
Took out all my growth. I mean, for it to live off of?
Right. Like if you took out everything that you made in the last couple of years, then you're back to basically square one and you can't support those higher prices. So you need to make sure your withdrawal rate is less than what you're earning.
Yeah, so what happens is you have to build a retirement income plan. And one of the things we want to offer to you is this. When you give Akers Financial Group a call, what we want to do is talk with you about your plan for your retirement income. Where is it going to come from? Where is the ability to give more income in the future? And the reality of it, if you're not retired yet, is we got to build these multiple sources. Of course, we recommend those that are listening that are younger. What you need to do is hear this and say, oh, I want to win in retirement. I'm going to need multiple sources of income. So I need to begin saving multiple ways to get that. If you're near retirement, we got to figure out how to make this happen. One way to make your budget work is to shrink your budget down. One of the best ways is to not have a debt payment so that you have more money for other things.
Exactly. And especially as other things increase, there's certain things in life that you have to have: shelter, water, food, right? So there's those things you can't cut out. But this could be a time where people have to make some hard decisions.
Absolutely. They're going to have to decide what to do, where to go because of driving. You might have to carpool. You might have to actually ride with people somewhere.
Yeah, get a bike.
A bike, yeah. Motorcycle?
Yeah.
Or electric car?
Yeah.
Okay. As long as you don't go too far, you're fine with that. So the idea is this: inflation is something you got to have as part of your retirement planning. You need to look at it, and how is it going to affect your retirement income? Can your income that you plan for retirement increase Or is it planned to increase during all those retirement years?
Can I ask you a question, Brian?
That sounds like a good thing to do.
What is a real rate of return?
Okay, a real rate of return that I learned at Virginia Tech is that if you make money after you paid taxes, after inflation, and you have a positive return, you've actually made real money. Now, that doesn't work with every style of investing out there. If your money's in the bank, in short-term money market CDs, you never are able to beat inflation after tax.
Now, I know you're not saying that all your money shouldn't be in the bank because you got to have some cash.
You got to have your emergency fund. You need to have possibly your short-term money that you have for a goal for this year. But once you get beyond that, you got to start building some medium-term investments that are going to try to at least get close to a real rate of return.
Yeah, and I love that analogy with the medium, the long-term, and then having different buckets of money based on the length of time. Because like you said earlier, 30 years is a long time.
What happens is this: when you give your money purpose, it'll dictate how to invest that money. And then you got to invest it based on the economic times we have so that you have a plan rather than an emotional guessing of the market where you pull in and out and make wrong decisions. You got to have a plan where you put things together, you work that plan and make this money last your lifetime.
I mean, I agree with you. So that's such an important thing. And I think what it boils down to is diversification.
Diversification, it helps extremely well when it comes to volatility and downside. It seems like when the markets rise, all the ships rise, and makes everyone look good on the financial side. But when you get hit a 10, 20, a 30% down in the market, and you look at your portfolio and we're down 5, 6% off of a 20% down, it's like, that's really not that bad. We've done a good job of preserving the wealth that people gave us.
And smoothing out that volatility, I think, is such an important thing when you have high inflation. Because if you're dealing with rising costs and big losses, that's a tough thing to deal with.
Absolutely. So imagine you had $1 million and you lost 50%. How much money would you have then, Alex?
500,000.
500,000. So how much do we need to earn to get back to $1 million? What kind of percentage? Why don't you think about it? You have your money and you retire with $1 million, and it's like you fell in a hole, a stock market hole. You fell down that hole, and then you're looking back up and go, oh, there's my $1 million up there. I need to get back to that goal. Have you thought about how much return you have to make to get there?
It sounds like a doubler to me.
A doubler means a 100% gain to get back.
Yep.
Now, let's take 2 or 3 different scenarios. One scenario is market went down 50. Oh, I got out because I didn't want to lose any more. What's the possibility of that going back to $1 million?
0.
All right, probably 0. I would agree it's very unlikely.
Because if you go from risky to conservative,
especially at the bottom, you're probably going to make a mistake. If the market goes down and then you say, all right, I need to take withdrawals while it's down, that means you're selling it while it's down. Probably not the best thing.
Well, I mean, and a lot of people in that scenario have to do that.
Well, they do because they didn't plan their income as well as they could, and that's definitely a topic we're going to have here soon. The other thing about $1 million dropping down, you need to make 100% to get back up. That might take 6, 8, 10 years to get all the way back.
Well, 10 years at 7.2.
At 7-point average, what you can hope for is that there's a little bit of a V action, a V where it bounces right back up like it did right after COVID began.
The dead cat bounce, they call it on the TV.
A dead cat bounce would mean it comes up and then, boom, it bounces back down and stays down for a while. What we believe in is that the companies in the U.S. markets, we think, will do well over time. Their growth rate is going to slow down. That's the whole purpose of higher interest, inflation, everything that's going on is trying to slow down the economy that we're in. And by slowing that down, we can actually catch back up when it comes to our supply.
Yeah, and it's such a weird time with supply chain issues, weird demand issues. But I mean, it boils down to pretty basic economic principles, right? Supply and demand.
And my answer is this. When you're in your retirement years, we want to beat inflation. The only way to do that is you need to look at your portfolio and take a reasonable rate of return risk. That means you need to have some of your money in stocks, in equities during and throughout your retirement years to make that money keep up with inflation.
I couldn't agree more. And you have to have a reasonable withdrawal rate too.
Absolutely. The reasonable withdrawal rate, extremely important, and understanding your plan that you've been putting together. Now, at Akers Financial Group, we are a local, independent financial firm. We don't report to a big company on Wall Street. We report to you, the client. We do have offices in Lutherville and Forest Hill. Clients all around Maryland, all around the Mid-Atlantic region, and actually all around the country with all the different states where people move and retire and change jobs to. Well, the Zooming's been incredible to be able to keep up with them. And we have some clients in other countries around the world. So it's easy to begin winning in retirement. All you got to do is give us a call at Akers Financial Group, and you can talk to one of our team of advisors for that free initial meeting. You can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you back on Monday to schedule your free in-person or Zoom meeting. Go to AkersFinancialGroup.com. Call us at 833-946-7384, 833-946-7384 to start planning for your retirement now. Did you know the Social Security could be $1 million decision? We'll explain that in this third quarter in just a couple minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Thank you, Mr. Announcer, for welcoming us back to Winning in Retirement. I am Brian Akers. I'm a certified financial planner practitioner, and I brought another certified financial planner practitioner, a CFP, as we say, with us today, and that's Alex Monk, coming out of the halftime locker room. Is the locker room, do you think of golf locker room, or which sport locker room do you think about, Alex?
When you say it that way, I think of probably basketball.
Yeah.
Or the team room where we used to take naps in high school, allegedly. But, the golf locker room's kind of different.
Yeah, that's just before and after, right?
Before and after.
Like when you're serious about golf, you don't take halftime at the ninth hole.
Well, you got to get a turn dog.
A turn dog? All right, definition of a turn dog is what?
It would be a hot dog at the turn.
Yeah, you get it from the shop, not from the cart.
Right.
It tastes a little bit better.
Definitely.
All right, we're not giving hot dog advice or turn dog advice, but we are covering the topic today is surviving and thriving in retirement. I guess surviving would be to understand the proper turn dog.
Yeah. Yeah.
All right. So surviving and thriving is this. We need to know what's going on and have a financial plan designed to handle the issues that are going to be thrown at us so that we are okay no matter what gets thrown at us in our retirement years. So we got to be prepared. That's called planning. It's called being thorough with our money. Yes, we can invest our money, and it's fun to invest and monitor and track and be active and manage. We love doing that for our clients, but bringing it all together so that the other side of it, where am I okay? Is there enough money coming in? Where's it going to come from? How about my taxes, estate planning, my long-term care? All these issues bringing together is a true and proper financial plan. All right, starting here in the second half, we have this question. Did you know that Social Security could be $1 million decision?
So if you think about it like this, right, a couple that lives average life expectancy, which is, somewhere in the mid 80s,
Yep.
at about $2,000 a month, Social Security benefit, it totals somewhere around $930,000.
Yeah, that's real close to $1 million.
Yep.
But how much time do people think about when to draw or have a strategy for Social Security?
It's usually about 15 to 20 minutes, and they come in and they say, I retired today and I drew Social Security.
Oh, yeah, I called Social Security. They said I could draw it right now, so I did.
So I did.
Yeah.
Or my uncle did this, or this guy at work did that, or, whoever they're getting their advice from. Mm-hmm. But, it's not a solid answer for everyone. So some people are terrified of the government. And then, if that's your huge concern, then maybe you should draw early. Mm-hmm. I don't necessarily think that's the answer for everyone. I think there's a lot of strategies out there that can work, depending on how old you are, how old's your spouse, who's got the higher wage record, who's, what's your family expectancy like? Like all these different things come into play.
There's some fundamentals of Social Security that we're just going to cover a couple quick topics. But the idea of fundamentals of Social Security is if you're 62 and still working, you probably should not draw Social Security. If you make more than like $19,600, I think that's the number this year. What happens is every $2 above it, you have to give $1 your Social Security back. So we don't want to do that. What we want to do is wait. So if you're earning income part-time and you're doing pretty well, you do not want to start your Social Security.
Nope.
Now, Social Security is designed around FRA, a full retirement account, full retirement age, full retirement age. And that's normally 67 if you're born 1960 or later. If you're born in the 50s, it phases out between 66 and 67 based on a little chart that we can find for you.
But I heard that we got some good news from them.
Good news from Social Security. That would never happen.
I heard that it's going to be healthy through 2035.
Healthy in that they don't have to drop it down?
Yeah.
All right, so it is true. There's an article about the study that was done on Social Security that now it's going to last like an extra year before they have to readdress and lower down, maybe possibly reduce Social Security benefits by 20% if they don't make any changes between now and then.
And that's only 13 years, and we're talking about retirement could last 30.
I was thinking about why would Social Security actually increase or get better, and my answer to that is the fact that so many people drew at 62.
Yeah, or I mean, unfortunately, maybe people have died. I didn't really. Well, I guess we did have some clients pass here recently.
Yeah, well, the idea is that Social Security is derived around when we take our benefit. If you're at full retirement age, 67 versus 62, there's a 30% difference if you draw at 62.
That's a big deal.
That saves the government money on their projections out. Now, the idea of making a proper decision on Social Security income can give you some of this money for your retirement years, but it can never be your only source of income for retirement. It's almost like guaranteeing that you're going to be in the poverty level if that's your only plan.
You won't have much taxes, but you won't have a whole lot of fun.
Well, you'll have enough money probably to pay part of your housing and to be able to stay wherever you're at.
Right, that's assuming like you have no debt, or because you still got to pay property taxes. It's
right, and there are people that we've met that had that situation, and we tried our best to try to find ways to add to their income, and there are some ways to increase income based on savings and help them try to find ways of having housing at affordable rates.
Yeah, but you don't want that to be your plan. Like, that's not the goal for our clients. We want them to save. We want them to invest and thrive and win.
Yeah, I guess the word thriving to me means that you have that energy of things are good. That energy of, okay, I don't have to worry about this because it's handled. I now can go thrive. I can go do these other things.
Yeah, like money is just a tool. And whatever you want to accomplish, that's really up to each and every individual client. Because like you said, everyone's got their own financial fingerprint. And what you do with your money is up to you. We just want to show you how to maximize it.
Yeah, so when it comes to Social Security, what we try to do with our clients, we have them come in, which we're saying the same thing to you right now, is you come in and you say, hey, can you do some Social Security strategies for us? Can you run that through your Social Security calculator and figure out when is the optimal time for us? And then we ask you questions. We want you to truly log on to Social Security and get the actual numbers that they have right now so that we can see those numbers and plug them in and then talk about your situation and try to plan what's best for you.
The one question I always ask people, I said, okay, great, this is an easy calculation. When are you going to die? And they're always like, it's funny. Some people, they say a number immediately. Some guys are like 85. And the wife's like, no.
Well, it's people think about their parents, they think about grandparents, think about history of their family, and they talk about how their health is going. Then they try to project that out. The sad part is we don't know how long we're going to be, which I think is actually a good thing not to know. But what happens is if you're in that 78 to 82 life expectancy range, typically drawing it earlier, it makes sense. If you think you're a 90 to 100, the idea if Social Security stays the same, you might want to wait a little longer.
And it's always worth hedging your bets, because I can't tell you how many times I've seen someone come in like, Alex, I'm not going to live another 5 years. 10 years later, they're still alive. And the person that we thought was super healthy passed away. So it's, it's out of our control. But there are strategies that we can use to mitigate that risk.
We believe when you have basically you have the spouses, the husband and the wife, you have them, and what you're talking about their Social Security. What you look at is which one has the highest Social Security number, and what we want to do is let that wait longer to draw that, and then the one that has a lower amount, we basically take that earlier.
Why is that?
And the idea is that if one of them passes away, the highest benefit is the benefit for the survivor. So it becomes a really a good way of having a higher survivor benefit by waiting a little bit longer.
Yeah, it protects it for the family. And that's the one you want, right? You don't want to lock in the tall, like the biggest one, lower. You want to keep that one. So,
yeah, absolutely. If you want to have Social Security strategies and actually have the ability to decide to wait, you must do other things like have savings. You must have money set aside in regular savings, retirement savings, tax-free savings, so that you can then say, oh, I don't have to have Social Security next month to survive. I have other money, so you can wait.
And those are some of my favorite planning opportunities. When you meet someone, it's like, okay, well, what can we do in those gap years where we're not necessarily realizing income? Can we live off cash and convert to Roth?
And we're like, yeah. We get excited about the Roth conversion calculation because in a volatile market, when stocks are down, that's a great time to do a Roth conversion, to convert those stocks over and then get the return up, all tax-free.
Especially if it's your asset allocation is correct, it's assets that you want to hold, that you're going to want to keep. Mm-hmm. Why not pay tax when they're lower?
Yeah.
I mean, I love it. It creates opportunity out of, what most people, they panic, they get a little fearful. There's always an opportunity.
Yeah, and when you say there's always an opportunity and you think, well, it's a little depressing with everything going on right now, you're saying that there is opportunities based on people, some financial situation that they need to take advantage of right now.
Yeah, so if you, in a normal portfolio, let's say you're well balanced, right? You have a balance between growth stocks, which would be tech, and then you have, some energy stocks. Guess what's up right now? Your energy stocks. So you're probably not going to want to convert them.
Right.
But if you have some tech names that are way down, some of them cut 50, 60, 80% from the pandemic high, that's an opportunity. If that's still a stock that you want to own, mm-hmm. pay the tax now and then let the recovery happen on its own time.
Right. You let the recovery happen. You mean let the economic recovery happen?
Right.
Okay. And as the economic recovery happen, it's all inside of a Roth.
Right.
And that what happens there is that will be all growth. If you had left it in the other account, that would be ultimately taxable, that gain to you.
Right. And you don't want to panic. You don't want to bail on your asset allocation. You don't want to bail on your plan unless it's wrong. Yeah. But you want to find ways to be opportunistic in any market because these things are going to happen and it will happen again.
It's almost like you're doing a Zoom meeting and everything looks a little hazy because it's not focused. And what happens in financial planning is sometimes you just got to turn just a little bit to focus to make things look a lot better. Financial planning and tweaking and doing that refocusing is an extremely important part of the initial planning years, is to get people focused in the way they need it to be for income, making the right decisions on when to draw their pension and joint survivor decisions, their Social Security decisions, how to draw income out of tax-free, out of the taxable side, all kinds of things all come together in a proper plan.
Yeah, and you can take the emotion out, and that allows you to be successful in any market environment.
Absolutely. Taking that emotion out will give you the ability to just say, well, I got things decided for the next year. I have money set aside. That's where my income's going to come from. I'm not going to draw out of the market when it goes down. Now, what we want at Akers Financial Group is this. We want that the best part of your retirement is when you get your time back or you decide how to use it. Before retirement, your time is tied up with other commitments. You all know it's mainly your job. A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You can go to our website at akersfinancialgroup.com. You scroll down to the schedule a meeting section and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com. Or you can go ahead and give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. Go to akersfinancialgroup.com or you can call us at 833-946-7384 to start planning for your retirement now. Warning, don't take your monthly income from the stock market. We will explain why in a couple minutes as we come back for the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Hi, I'm Brian Akers, and here is Alex Monk. Good morning, Alex.
Brian, it's a fourth quarter.
Oh, yeah. I want to welcome everyone back to Winning in Retirement. Yes, we have Alex Monk with us, so hopefully you found that enjoyable most of the time, right?
Hit or miss, man.
Hit or miss. But we're both certified financial planners, practitioners, where we work with our clients through Akers Financial Group. And what we do and enjoy most is helping people talk about their goals and reach their goals and watch them through the years accomplish all the many things that they had dreamed about. just previously, a few years before.
Now, I mean, you've been in this business for a lot longer than I have.
Yeah, you might say that.
I mean, 3x. I mean, 30 years, right?
Talking about shirt size, or we're talking about
three times as long as
that. 3 times as long. Yeah, 35 years this year since I began the journey at this, and I've enjoyed the career and the job, and it's something I enjoy doing with clients, helping them. I especially like to help them wherever their situation is. It's sort of like a puzzle. It's a situation where you hear their story, what they've done, and then you figure out what to do. And I think that's just an enjoyable job to do that.
Yeah, it keeps you on your toes, too. And the puzzle part is especially fun for me because every person's so different.
Yeah, so this week, Alex and I have been talking out in public at some seminars we had with 35 people each night, and we're talking about surviving and thriving in retirement. So we thought we'd take that same topic and bring it to our radio listeners. There was some radio listeners at the seminar, which we thank them for listening and coming. That was pretty cool.
Yeah. Yep.
That's all you got to say about that one? No, that's okay. But here in the fourth quarter, we got to wrap this all up, finish it all strong, and understand why we think it's so important to think about getting everything in the right places, getting things organized and planned out so you can make wise decisions. So it's your money and your everything that you got going on in retirement. You can thrive throughout your retirement years, not just survive and just barely make it, but actually thrive where it's actually accomplishing all those goals that you set up. So throughout the show, what we've been doing is talking about, we started out talking about just basics when it comes to retirement planning. We got into retirement income planning. We got into inflation talks. We talked about Social Security and some basic strategies. All of these are topics that we cover in our meetings with our clients. We do a retirement income analysis. We do Social Security strategies. And we also do a stock market risk analysis. And part of that has to do with this question I have for you, where I was saying earlier about a warning. Don't take your monthly income from your stock portfolio. Now, why would we tell people to not do such a thing? So
you do not want to sell blindly. Now, if you're taking dividends and things like that off your stock portfolio, that's fine.
Yeah, that's milking the cow.
That's milking the cow.
We like that.
Right. In the beginning, I don't know if you were listening, but I mentioned yogurt, something like that. Not really sure how that's made, but I know it's dairy. So we do not want to kill that cow every month because sometimes the cow's sick. Like right now, I mean, it feels like this year has been so down. But realistically, year over year, if we look June to June, we're about flat.
Okay.
But if you looked at your statements at the end of the year compared to now, your attitude's going to be much different.
Well, most people like to go back and look at the very, very high point of the year and say, well, that's where my money really was. And they don't understand how markets can get overextended and pop up. And then when they go down from there, it's sort of a quick ride down. Then it starts to level, and then it can bounce around towards the bottom for a while.
But the main key is we want to have our money identified so that we can take out that market volatility and not have that as a risk to our success. You know, thriving in retirement sounds a lot like winning in retirement to me, Brian.
Absolutely. And part of that would be where is next month's check coming from? What is your retirement income plan when it comes to this? Is it coming from stocks? So when Alex was saying earlier about pulling money out, taking money out monthly, there's many examples out there. But if you're taking money out in a down market, you basically are multiplying your losses.
Yeah, you're locking it in. So you have no chance of coming back if you sell it at the bottom.
Sell it, take it out, and then
you're toast.
Only what's left in gets to grow back. Now, sometimes when we see people that come in for their first review and get a second opinion, we see what they're doing already, and we realize that we might not like the approach that was being made. Some of the approaches we've seen are people that withdraw too high. They withdraw from too risky of investments. They just take a check out of their stock portfolio every month, and the manager sells a little bit of everything every month.
And they don't care. That's what they do.
It's just automatic. It's harder to take some profit, set it aside, and then fill it back up every year.
Well, it takes a little bit of thought, you know, and I'm willing to do that for my clients because it's the right thing for them and it will make their money last a lifetime.
So imagine that if the market's down, you need somewhere else to take it from. What are examples of some places you could take income from right now if the market is down 20, let's say?
Well, let's start with something super boring. Let's start with CDs and a checking account or a money market.
Okay, so you use some cash.
Some cash. Now, if you run out of cash, let's hope that you have maybe a stable value fund or a fixed annuity or even a fixed indexed annuity, something without any downside risk.
So you could take the money from your protected side to provide.
Right.
What are some other ideas?
You could take income off of real estate.
Okay.
You could take profits from stocks that are up. Like, let's say you were overweight energy going into the pandemic. It went way down. Let's hope you held on. Well, now it's way up. Maybe you need to look and rebalance.
Oh, yeah.
It just really depends on where your money is overall. But the key here is you need to be diversified and you need to have stuff that is not going to go down when everything else is down.
Yeah, so when I hear Alex explain that, what I hear is this. All right, so I need, say, $2,000 a month from my portfolio. I shouldn't just take a little bit from everywhere. We need to have a strategy. You need to basically make a decision on where the right place is to get the money.
Well, and let's say you're in the scenario where, you have a current money manager, right? And your portfolio's, I don't know, 60-40, 60% stocks, 40% bonds.
You mean like on target?
Or a target date fund.
Yeah.
So let's say the stock side's down somewhere between 10 and 20.
Yeah.
What are your bonds down? Your safe money.
7 to 13, depending on how risky the bonds were.
So that doesn't sound like safe money to me, Brian.
No, it's down. It lost money. And that's what happens when your interest rates start to go up. Interest rates have just started to go up. As interest rates really start to truly rise over the next couple of years, that's when the bond funds, the collection of bonds, are going to have a hard time keeping up.
Right. And you hear people in the news saying, oh, well, we think this is going to be the end of the bond bull run, the 20-year, well, it had to end eventually because interest rates typically have never gone negative in the U.S.
Yeah, the bonds have been good for about 40 years, basically my entire career until the last decade. I've been warning about this, is that we got to be ready for it. And we have to have the ability to have our money not go down if we're going to have some position that's protected. Now, when you're thinking about retirement years, we recommend that you take the least amount of risk to reach your goals, not the most amount of risk. The younger you are, you can afford to take risks to go down and buy low again and watch it come back up. But when you retire, you don't want to take the risk of losing your principal with all of your money. You want to balance this out.
Absolutely, because you may have 10 years, you may have 5 years, but you don't have working years. You don't have the ability to add to things when they're down because you're living off that money now. It's a complete shift.
And I would say a lot of people don't really know where their money is. I mean, what that means is they've accumulated throughout their lifetime. They understand the statements, but they don't understand, which one's risky, which one is okay for right now, which one's earning me money, which one's not, what are my options? And that's what we do is we take a look at where people are and we say, well, these are what you put together over your lifetime. And when we compare your risk and protected money and we say, well, it looks like you have this portion. We don't think that's exactly right. We probably should make some tweaks and changes in these cases.
Right. And sometimes you have to give something up when you're not giving up risk. Like if you're not willing to lose principal, you may have to give up time or you may have to give up some return potential. But you have to say, okay, is that a good trade-off? And right now, you're not down 15% or 10% like bonds are. So I would say, yes, that's a good trade-off.
Yeah. I was trying to think about when you take all the risk and you go up and down, the emotions of being retired on that have got you have to start thinking about, I need to lower my payment now because the market's going down. I got to take less money out because it's down. And then what happens is, what are you going to do with your retirement years? You're going to have to live at a lower level. Inflation's pushing where you need more money, and then the market's coming down where you might think, I got to take less money out, and you're thinking, well, what do I do? And we think the answer is you cannot have all your money in the market. You need to have some in there because we want to beat inflation overall over time.
And really, the stock market's the only way that you can do that. I mean, where else are you going to go to get that kind of return?
And we need a portion in stocks, but well diversified. We do believe that dividend stocks, value investing is a really great place to look at. It's been a great place to be the last year and a half. We think it's going to stay that way for a while here.
Yeah, and things are cyclical in the market, so you can't. you can go overweight a little bit here and there, but you don't want to jump all into one. Like it just doesn't make sense. You're trying to predict the future, and I don't want to do that for clients because I hate being wrong.
What we want is this. We want you not only to survive, we want you to thrive in your retirement. So this show today has been about surviving and thriving in retirement by fixing the issues that your portfolios, your planning might have so that this money can last throughout your lifetime and beyond. So the idea is this. We've talked about retirement income review, where we talk about where's your money coming from, how to see, how to improve it, and how to make sure it can keep up with inflation. We talk about Social Security, having the ability to check out strategies. And then the third thing is to do a basic analysis of what kind of risk are you taking with your portfolios. All three of these ideas can come together by setting up a free meeting with one of our team of advisors.
And it's something that we love to do. So I absolutely love it. I can't imagine doing anything else.
You like the calculating? You like the talking? Which part do you like?
Well, I obviously love to talk, but I like the whole thing. I like seeing how it fits with people. I like the puzzle, man. It's so much fun.
I like preparing it. I like working on it. I do like 10, 12 years later that it works, and it works very well. Like when clients come in a down market and I say, well, look at our portfolio. It's working exactly the way we designed. It didn't go down as anywhere near as far as the market. You're okay. And they're like, oh, yeah, well, we are. That's great. And they're very happy that the whole plan worked. And I think that's the key to having a properly done plan. Thank you very much for a good show today with Mr. Alex Monk.
It was fun, Brian.
And we thank you, the listener, for listening to our show. We want you to win in retirement. And to do that, we want you to take advantage of the opportunity to begin planning with us at Akers Financial Group. Go ahead and schedule your free meeting with one of our team of advisors by going to our website at akersfinancialgroup.com. You scroll down to schedule a meeting section and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com. Or you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or give us a call at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.